Hello everyone, welcome back to my channel. What I'm about to share with you today is absolutely mind-blowing, and it's happening right now in real time. The silver market has just split into two completely different realities, and if you understand what's happening, you could potentially profit from one of the biggest arbitrage opportunities we've seen in precious metals history. But here's the catch. This window is closing fast, and by the time most people figure this out, it'll be too late. So make sure you're subscribed and hit that notification bell, because the information I'm sharing today could literally change your financial trajectory. Silver is trading at $93 in China, while the US price is lagging by a full $8. Let me repeat that because it's absolutely insane. The same metal, the same asset, two completely different prices separated by geography. This isn't normal market behavior. This is a signal that something fundamental is broken in the global precious metal system. Let me paint the exterior picture of what's happening on the ground level that everyone can observe. Walk into any precious metals dealer in China right now, and you'll see silver trading at $93 per ounce. Meanwhile, across the Pacific in the United States, that same ounce of silver is trading around $85. That's an $8 gap, which represents nearly a 10% price difference for the identical asset. Externally, what we're witnessing is unprecedented. International arbitrage traders who normally would jump on this opportunity and equalize prices across markets are finding it nearly impossible to execute trades. Why? Because the mechanisms that typically allow silver to flow from low-priced regions to high-priced regions have been disrupted. Chinese buyers are paying massive premiums because they can't access international supplies easily. American sellers can't efficiently ship to Chinese buyers due to export complications and delivery restrictions. The exterior landscape shows a fractured global market where traditional price discovery mechanisms have completely broken down. Major exchanges are reporting massive volume differences. Chinese silver futures are trading at volumes 3 times higher than normal, while US markets show relative stability, but with growing tension. Physical dealers across both regions are scrambling to understand how long this disparity can persist. The interior mechanics of this price split reveal something even more concerning about the structure of global silver markets. Internally, what's driving this massive price differential comes down to supply constraints, currency pressures, and capital controls. China's domestic silver demand hasn't decreased, but their ability to source international silver has become severely limited. And this creates internal market pressure that drives prices higher within their borders. Meanwhile, the US market still has relatively stable access to various silver sources, keeping domestic prices lower. Interior to the market structure, we're seeing the breakdown of what's called price arbitrage efficiency. Normally, when prices differ between markets, traders buy low in one market and sell high in another, which equalizes prices almost immediately. But the interior reality right now is that these arbitrage mechanisms are dead or dying. Capital can't flow freely. Metal can't ship efficiently. Regulatory barriers have created walls between markets that didn't exist before. The interior pressure building in China's silver market specifically comes from their industrial consumption needs. They require massive amounts of silver for solar panel production, electronics manufacturing, and battery technology. When external supplies get cut off or restricted, internal prices must rise to ration the available supply among competing domestic users. This interior market dynamic is creating a pressure cooker situation where Chinese buyers are willing to pay almost any premium to secure physical metal. The performance implications of this price split are staggering for anyone paying attention. Silver's performance as an asset class has always been tied to global price discovery. But now we're watching two separate performance trajectories emerge. In China, silver is performing like a critical shortage commodity, with prices jumping double-digit percentages in short timeframes. Performance metrics show Chinese silver gaining value faster than almost any other commodity in their market. Meanwhile, US silver performance remains relatively muted, tracking more closely with traditional precious metals movements and showing much less volatility. This performance divergence creates unique opportunities, but also significant risks. Traders who understand this split are attempting to position themselves in US markets, expecting that eventually American silver prices must rise to meet Chinese levels, or Chinese prices must fall to meet American levels. The performance question becomes, which direction will the equalization happen and how quickly? Historical data from previous market dislocations suggests that when such large price gaps exist, the lower-priced market typically rises to meet the higher-priced market rather than the reverse. This is especially true when the higher price is driven by genuine supply shortage rather than speculation. The performance of silver in this environment also depends heavily on whether these restrictions persist or get resolved quickly. Every day this $8 gap continues. It represents $8 potential profit for anyone who could successfully execute the arbitrage trade. From a safety features perspective, This situation screams caution for certain types of investors, while presenting opportunities for others. The safety consideration here revolves around understanding where you hold your silver and in what form. If you own physical silver in the United States right now, you're theoretically holding an asset that's undervalued compared to global demand. From a safety standpoint, this means your asset has upside protection. However, the safety risk comes from the fact that if this situation resolves through Chinese prices falling rather than American prices rising, you could see stagnation in U.S. silver values. The safety feature of holding physical silver during this period is that you're protected from counterparty risk and paper market manipulation. But you're exposed to geographic arbitrage risk. Paper silver holders face different safety considerations. ETFs and futures contracts may not accurately reflect the true global price of silver when markets are this fragmented. The safety of these instruments depends entirely on which market they're tracking and whether they can actually deliver physical metal if demanded. The safest position from a wealth protection standpoint appears to be physical silver held in the lower priced market with patience to wait for price equalization. But this requires confidence that equalization will happen and capital that can remain tied up during an uncertain time frame. The unique selling points of understanding this arbitrage situation right now are absolutely critical. First, knowledge advantage. Most retail investors have no idea this price split even exists. By understanding it, you're already ahead of 99% of the market. Second, positioning opportunity. If you believe U.S. silver prices will rise to meet Chinese levels, buying physical silver in America right now at $85 could yield significant returns when prices equalize. Third, market intelligence. This price split tells you something profound about global supply chains and currency flows that goes beyond just silver. It's a signal about broader economic fragmentation happening in real time. The unique opportunity here isn't just about silver prices. It's about understanding that we're watching the global financial system fragment into regional blocks with different prices, different rules, and different access to commodities. Those who recognize this trend early can position across multiple assets, not just silver. The unique selling point of acting now rather than waiting is that arbitrage opportunities don't last. Markets eventually find ways to equalize prices. The longer you wait, the more likely this gap closes before you can benefit from it. Now, let's talk about price, because this is where the rubber meets the road for practical investors. The price differential we're discussing is stark and simple. $93 per ounce in China versus $85 per ounce in the United States. That $8 gap represents your potential upside if you're buying in America and U.S. prices eventually rise to meet Chinese levels. But price analysis requires more nuance than just looking at the gap. You need to consider premiums, transaction costs, storage fees, and opportunity costs of capital. If you're buying physical silver in the US right now, you're paying spot price plus dealer premiums, which might add $2 to $4 per ounce depending on the product. So your real entry price might be $87 to $89, even though spot is $85. If US spot rises to $93 to match China, your actual profit per ounce might only be $4 to $6 after accounting for your premium costs. Still significant, but not the full $8 the headline suggests. Price considerations also include the time value of money. If your capital is locked in silver waiting for a price equalization that takes 6 months or a year, what else could that capital have earned? Price analysis must account for these opportunity costs. Additionally, watch the trend in the price gap itself. Is the $8 differential widening or narrowing? If it's widening, that suggests the situation is getting worse and equalization might come through crisis rather than gradual adjustment. If it's narrowing, arbitrage might already be happening through unofficial channels, reducing your potential profit window. In conclusion, what we're witnessing with $93 silver in China, while US prices lag by $8, is a historic moment that reveals deep fractures in global commodity markets. The arbitrage that used to keep precious metals prices equalized across borders is dead or severely wounded. Whether this represents a temporary dislocation or a permanent shift toward regionalized commodity markets remains to be seen, but the implications are massive either way. For investors, the key takeaways are clear. Understand that silver prices are no longer truly global. Geographic location matters more than it has in decades. If you're positioned in lower-priced markets with the ability to hold physical metal, you may have significant upside as prices eventually equalize. However, don't assume equalization is guaranteed or that it will happen quickly. Market fragmentations can persist longer than logic suggests they should. Stay informed about developments in both Chinese and American silver markets. Watch the price gap daily. Monitor whether it widens or narrows. Pay attention to any news about easing export restrictions or improving international silver flows. Most importantly, make decisions based on your own financial situation, risk tolerance, and investment timeline, rather than chasing theoretical arbitrage profits that may never materialize. This channel will continue tracking this unprecedented situation and bringing you updates as this story develops. If you found this analysis valuable, smash that like button.